This is Made for More Living with Johnny Jennings, powered by eXp Realty. Online at madeformoreliving.com.
So I'm here with Paul Frank. He is the president and CEO of PDF Group of Companies. And in the previous segment, we were talking about how your dad helped you get started in the industry, or he was an influence on you in the industry. And he said something to you when you were 7 years old. He said, don't do a deal for the sake of a deal. Is that right?
Don't do a deal for the sake of doing a deal.
Don't do a deal for the sake of doing a deal. And that saved your bacon. One, that's crazy that you remembered it at 7 years old.
Vividly.
It's like man, that's so incredible. And so he said that, and then you're going through the industry and you're in the commercial space in 2005, 2006, and
yeah, going into 2007, before it all hit the fan, yeah.
So you saw and so you're going in that, and you just heard your dad's voice, don't do a deal for the sake of doing a deal.
Yep. The banks were willing to give me any amount of money to do any project because I had a long history of success, and it was tempting. It was very, very tempting. Hard to walk away from the table, as my dad would put it.
And how, at that point, in 2007, how long had you been in the industry?
My entire life. Like I said, my dad started dragging me around when I was 5 years old, and he struggled and worked his tail off throughout his career. I remember to the point, before we had these computers and I accessed all of this information, he used to set me up with some peanut butter sandwiches and chocolate milk in a lawn chair at a corner with a little map, and I would count cars because he was trying to put 7-Eleven deals together.
Really?
So we didn't have access to all this stuff. So I would sit there for the entire day and make little notes and count the cars, making left turns, right turns, which way they went.
And would he make like business decisions based off your count?
Well, like Southland Corporation back then would, yeah.
What?
Yeah.
That's so much trust in a kid.
Yeah.
So
I didn't quite understand it, I'm sure.
I don't know if I would, I don't know. My kid's only 2 years old, so we'll see what he's like when he's 5 to 7. But man, that just means your dad probably saw a lot in you at an early age.
Free labor.
Free labor. But it's expensive labor if the count's off.
Yeah. Yeah, that's true.
So what I'm seeing a lot of, and honestly, I've have an interest in it personally as well. Like Grant Cardone, I'm sure you've heard that name before, talks of, like, he has kind of brought commercial real estate, at least to the forefront of many people's minds, whether it's 16 units or more. But commercial real estate is more than just a place for tenants to live. There's so many different classifications to it, correct?
Correct.
And so with that awareness, I'm also starting to see more people inquire because there's so many people competing for single-family homes. Are they even a good buy right now? There's a lot of conversations around that. Are you seeing an increased interest in commercial properties at all?
Yeah, I do a lot of Zoom calls and teaching in the commercial space for residential agents and investors. And there is definitely a lot of interest. I mean, there's a lot of people out there speaking on the internet and other places about the subject. So it definitely garners a lot of attention and questions.
So when you're teaching on it, what are the biggest things that you see potential investors be surprised about or pitfalls that they can fall into? Yeah,
without question, the biggest differentiator coming out of the residential space to commercial is CRE finance, commercial real estate finance. I tell people everything you know about finance relative to residential, throw it out the window when you get into the commercial space because there's some shocking differences too.
So you were sharing that some of those differences include, hey, as long as you can qualify for the monthly payment, whether you're paying that, you got to qualify initially, but 5, 6 years down the line, whether you're paying it or your relative's paying it or somebody else is making that monthly payment, the big banks don't care as long as the checks are coming in. But that's not how commercial financing works, correct?
Correct. Yeah. So whether it's a single family residence or anything that 4 units or under that falls into residential finance, it is based on individual capacity to serve that debt. So you could get somebody that's making $2 million a year and go buy a $5 million second home. As long as they make that payment every single month, it's based on their ability to pay and their actual payment history, right? Nobody bothers them. They could be selling assets, borrowing money. As long as they make that monthly payment, B of A or Wells Fargo doesn't talk to them. In commercial, it is, for the most part, and this is a generality, but it is asset-based. It's the performance of the asset that underwrites the debt. So that same person that bought a $5 million second home goes to buy a $5 million little retail center. They are shocked to find out that there is all sorts of criteria and requirements that aren't required of that second home that are definitely differentiators.
So what are some basic qualifications? Like, what does a property have? Is it based off cash flow? Is it based off the age? Like, how do you determine that? So
the first of all, in residential, let's say you have a 30-year fully amortized loan. You've got 30 years, 360 payments, equal payments. In our world, or CRE finance, the norm for an investment property is a 25-year amortization. So that's the period of time that the payments are calculated on. We have what's called a 10-year term, which is equivalent to a balloon payment. So every 10 years, you got to refinance the property.
Wow.
And then we have usually a 5-year rate reset. Even if they call it a fixed, you have a 5-year rate reset. So if you look at that continuum, you start out with a loan, it's a 25-year AM, you got a 10-year term or call, and a 5-year rate reset. And it's that 5-year rate reset and the 10-year term that creates a lot of turbulence, because if you qualified for a loan, or a property did in year one, if you're in a different performance and interest environment at 5 and 10, it can create some significant problems.
Why do they do that? Why are all these extra requirements?
You know, the thing that, and I don't know this for a fact, but I know I've been doing this a long time, and this is what I've discussed with lenders, is that, and you'll know this, what's the typical time that somebody's in a home mortgage?
Like 5 to 7 years.
5 to 7 years. So people sell houses, buy houses for a lot of different reasons: divorces, deaths, kids, all job changes, right? There are factors that influence that turnover.
Definitely.
In commercial, if you got a 30-year fixed rate loan at 3% on a $20 million retail center, you would never sell that in a 6-7% environment. The bank would be exposed to that 3% debt for 30 years potentially. So from my experience, it's that exposure. This guarantees, for the most part, a turnover of that debt exposure in 10 years or reset in 5 years.
Okay. And then you said there's also even like issues where technical default can come into play on an annual basis.
Yeah. So essentially, and this is one of the most shocking things that new participants in the commercial space will run into, is these annual reviews. So essentially, we will have covenants in a loan that require a certain liquidity, occupancy, all sorts of different things. One of the biggest is DSCR, or debt service coverage ratio, which is the difference between the net operating income of the property and the payment. So the floor these days is of a DSCR is 1.3. So if you can picture a loan payment of $10,000 a month, the bank wants to see a minimum of 1.3 times that, so $13,000 a month in net operating income. If that net operating income is $12,500, it's still positive $2,500 a month.
Yeah.
But it's in technical default because it's not meeting that floor requirement, which gives the bank the ability to foreclose for technical default.
Wow. So is the bank likely to foreclose for technical default in situations like that?
It depends. I mean, they want to get out of the property's hole, and they will analyze the picture. Sometimes they'll work with situations, and other times they'll recognize that as their opportunity to get out, get their money out of it. And it's interesting you bring up Grant Cardone. I was at an event with him a couple of years ago, and his entire 10X system, if you will, he talked about the source of that, and where that came from was, and I don't want to quote Grant verbatim here, but essentially I believe he had $50 million in debt back in 2008 or so.
Correct.
And the banks called him in and called him on all of his debt. And he said, "What are you talking about? I'm performing. All the loans are current." Well, he was in technical default.
Yep.
So he went home that night and said, "Hey, good news, bad news," to his wife, and said, "Hey, banks are calling all of our loans. Good news, I figured it out. We need to 10X this and owe $500 million instead of $50 million, so we're too big to do this to."
Exactly.
The efficacy of that strategy I can't speak to, but that's where he says the 10X came from.
That's 100%. I've heard the same story from him a couple of times. And but my question is, if you're in technical default, like let's use Grant's, for example, or a hypothetical, how do you, because he didn't default on any of the properties, how do you get out of technical default? Like, how do you reverse that process? Well,
and I teach like I said, I teach this class to residential agents and new people, but if you can picture a 5-year rate reset and you have this DSCR, right, the performance, now all of a sudden you're in our example that we had $10,000 a month with a 1.3 DCR means you got to bring in 13,000.
Yeah.
Well, now let's assume that 13,000 net operating income isn't changing, but now a rate reset turns that 10,000 payment into 12,000 a month. You're still positive $1,000 a month, but you're in technical default. So your choices are pay the loan off, pay the loan down. So now the payment on that will be 1.3 compliant with the net operating income, or potentially foreclosure. Those are the three choices.
In any instances, are you able to refinance the debt?
The rate reset really is a refinance in the current environment, if you will, or even the 10-year is in the current rate environment. You potentially could go to private lenders and, hard money loans to try to get around that DSCR, but that's obviously pretty dangerous.
So if we're on year 4, you're in technical default, it's going to reset in 5, interest rates have dropped, you're saying that typically you wouldn't just refinance early? Are you locked into that 5-year?
Well, and that's an interesting thing too. Typically in commercial loans, you'll have a prepayment penalty.
Oh, really?
Usually it's a 5-4-3-2-1 is sort of the standard.
Like 5%?
5% first year, 4-3-2-1. There are some other structures to prepayments, like what's called a swap in commercial real estate that can. That's sort of like betting on the come line on the crap table. It's just it's a very complicated equation to come up with a prepayment penalty that takes the bank to calculate that for you. But to your point, you have to, if you get 3 years in on the loan, you've got a prepayment penalty that you've got to calculate into that as well.
Man, it just seems like a totally different animal for an investor to get involved in commercial.
100%, totally different.
All right, so when we come back after this, we will be discussing the major pitfalls and whether or not somebody even should consider investing in commercial real estate.
Man, I love getting to work with experts and professionals because there are so many things in this world that seem so overly complicated, and all of a sudden you talk to an expert like Johnny Jennings and you're like, oh, I'm so glad you know what you're doing and I don't. Because my house isn't on the market, but I was having some issues and I was asking Johnny Jennings for some advice. He's like, this is what you do. And he connected me with some people and we were able to find an answer to my question. And that's what I love when you work with a professional like that. He's going to take care of you and make sure that all of your questions are answered.
Sure. That's the difference with Johnny Jennings and the Tom Daves real estate team. They are all about service and trust and taking the time to answer all your questions. So if your question is, well, what would my home sell for? Go to tomdaves.com, type in your address. Right away, you find out what kind of offers you would get, the low and high end, and listen to this, how much you would get if you wanted a cash offer for your home today, no matter what kind of condition it's in. The website again is tomdaves.com, or you can give Johnny Jennings a call today at 855-TOM-DAVES. License number 581837.